Hello, this is Russ Murfitt with U.S. Investors and LPL Financial. I'm going to record a session today, which is a quarter two update for the markets. And let me get started here with a slide deck to explain some things I'd like to get across. Um, First thing is we're trying to just make sure that we always have an informed group of clients, and we can do that best by getting out with some information to you. And I'll start with the fact that there's no denying that the elephant in the room right now is the market. This has been a tough year to get started. The Dow Jones average is off to its worst half of a year since 1962, and the S&P 500 is its worst half since 1970. It's unpleasant to watch, and it can make people very impatient and uncomfortable. You can see the worst of it was the second quarter. Both the Dow and the S&P 500 were down substantially. The Dow down 11 and the S&P down 16%. It's a far cry from the bull market that we've gotten used to, and the equity market's more than doubled from March of 2020 to January of earlier this year. A famous investor named Warren Buffett says that the stock market is a device for transferring money from the impatient investor to the patient. So let's break down what's really going on. Yes, the S&P 500 officially is in a bear market. The Federal Reserve raised interest rates by 0.75%, which is the biggest rate change since 1994. Their narrative said we should expect additional rate hikes this year, and that's the daily debate that you'll hear in the news. Are they going to raise again or not? And we also see unrest in the world, particularly with the war in Ukraine. And COVID's not over. China, the second largest economy in the world and a manufacturer of mass products, still holds a zero COVID policy and could have lockdowns that could affect the supply chain at any moment. It's been an unrestful quarter. But it's good to keep in mind just exactly where we are. If you look at a chart that shows how far down the market went back in March of 2020 and look at where we are today, we've still seen substantial move. Even with the down moves from the beginning of the year, we're still looking better than a lot of people expect the way you hear them talking. As we mentioned, S&P 500 is officially in a bear market, and that's defined by markets dropping 20% below a previous high. The good news is, historically, they don't last that long. Bear markets last an average of 9.6 months, while bull markets last 2.7 years. The long-term average frequency between them is 3.6 years. So we were due. Since 1930, the market has been bearish for a total period of time of 20 years. That means that stocks have been up for 71 years. Many reports are saying that recessions usually follow bear markets. However, facts look a little different, and we share that 26 recorded bear markets, a little more than half, came with a recession. So it's not always going to bring a recession with it. While we now have 2 consecutive quarters of declining gross domestic product, the lowest since the pandemic, and consumer spending is still strong. That's one of the things that's different for most of these recessions. Remember, equity markets are still well above the pandemic drive declines. While possible, numerous experts believe we will not see a recession in the near future. However, there is cause for concern, and we're keeping a close eye on it as we go along. Please understand that even if we do go into a recession, that does not mean that investors will get wiped out. We're seeing a lot of concerns about things from the past, and remember, a recession does not equal the same as the Great Depression. Although there is no established formal inflation target, Federal Reserve generally believes that an approximately 2% rate of inflation is acceptable. The annual inflation rate for the U.S. was 8.6% for the 12 months that ended this May. Where were we seeing those the most? Well, you know the answers. The gas prices, groceries, housing prices all saw heavy increases in the last year. So standing by its commitment to fight inflation, on June 15th, the Federal Reserve raised rates again, this time by 75 basis points, the biggest rate change since 1994. Add that to the 75 basis point change they implemented earlier this year, and this brings the rate to a target of 1.5 to 1.75%, which is historically very low. In late June, the Dow dropped below 30,000 for the first time since January 2001. Safety comes with a cost. If you've seen what interest rates are at the banks lately, they are coming up a little bit, but still quite low. And even in the overall risk level, equities still may be considered an important part of a diversified portfolio. I think volatility will likely be with us for a few months, so it's important to be prepared. Remember, having a long, well-organized plan will help. As you can see from this chart, even with the downturn, long-term investors who have stayed invested over the 10, 20, 40 years were rewarded well with considerable gains. It's emotional at times, though. We know that, and it's when the markets are at their best that we feel the most euphoric, that we're actually at the most risk. So it's important to look at where we truly are now within your overall plan, and there may be some opportunities for investments at lower costs, excuse me. But watch out for more interest rate hikes. Borrowing is going to get more costly, and there are many variables that could affect the speed and direction of the economy. Things to do to be in control of your own situation is review your income-producing investments, lock in mortgage rates, or consider refinancing if you haven't already. Maintain liquidity, and if you find it interesting, please give me a call. Come in for a full review of your financial plan, and let's see just where you are. So proceed with caution. That's where we are today. And if someone's important to you and you'd like to share some of the information that I provide to you, please don't hesitate. Give me a call. Be happy to share that with them as well. Thank you, and we'll talk to you soon.